How do I get from the panic of 2021 and look out to 2024 or 5?
Yeah, that's really interesting viewpoint today, Tom, because when you think about it, Morgan Stanley is trying to distinguish between its long-term view, 2 to 3 years out, and its short-term view. And as you know, we're a little tactically cautious here in the short term, given how far markets have moved and given we may be lapsing some of these peak rate of change on earnings and policy, et cetera. But to your point, when I look out 2 to 3 years, I'm extremely optimistic. There are several mega trends here that will probably make this cycle hotter for the next several years, including a very powerful consumer rebound that goes on, talking about pent-up demand for services, including digital investments, which is really one of the main takeaways from the COVID experience. It was a massive digital wake-up call. So we're going to see investment in technology through many sectors. That's going to be a boom to the economy going out. And then lastly, it's all about demographics. We're actually going into a bullish time in terms of demographic shifts where the millennials, who are now a bigger part of the population than the boomers, are reaching their peak earnings in investing years, and that's going to drive flows.
Dan, let's pick up on a couple of pieces. The first one, peak rate of change. This cycle is so unique and so different that we're seeing peak rate of change right at the beginning of the recovery. Just because of the nature of the slowdown, it was mandated reopening mechanical pop back. Why is rate of change so important still, given how unique this cycle is?
Yeah, so everything is happening just faster, Jonathan, to your point. And so looking back at previous cycles, this recovery is happening twice as fast, to your point. And so that's certainly running up against some headwinds now in terms of earnings rate of change. When I look at just earnings season thus far, and we heard a mixed bag overnight, some reported above expectations, some below. When I look at earnings thus far, we're halfway through. Over 80% of companies have reported beats, and yet the average stock reaction on the day of report is down 20 basis points. So why is it important? It's important because we're up 80% off the March 23, 2020 lows, and it simply means that we could be due for a little bit of a pause here. It doesn't mean we're diverging from the longer-term bull market, to be clear.
There's an issue that you and Mike Wilson and the team have brought up repeatedly, and that's execution risk on the cost side. Labor markets tightening up, maybe harder to hire, harder to meet that demand with supply. Yesterday, what we saw from big tech was a cyclical story embedded in those big names that we haven't discussed enough. Dan, is that going to be the cleaner way to leverage the cyclical trade without the worries about higher costs?
Yeah, that is an interesting way of looking at it, Jonathan. We are certainly actively looking at tech and being selective in some of the growth space. And as we've talked about in the past, we're going to do more outside our houses finally this year, but we're never going back to 2019. And you're already hearing big financial companies talk about hybrid models, how much time they allocate in the office, and what that's going to do, frankly, for the demand for cloud, digital services. So, kind of looping back to your original question, we see these trends going on for several years. There is some cyclicality embedded, particularly in the advertising leverage names. And that's what you saw, over the last 24 hours. And so we do think that's a opportunistic thing to play.
On the flip side, do you think that the underperformance of the Russell 2000, of the classic small caps, which has been the traditional cyclical play, that underperformance will continue?
We do, and we saw, Mike Wilson, our strategist, downgrade small caps going back over a month ago. A well-timed move after being quite bullish for a year. And to Jonathan's point earlier, small caps, smaller companies are one of the areas that really acutely feel the cost pressures and have limited ways of offsetting those cost pressures. So yes, we do see small caps continuing to struggle here near term as things adjust. And we want to also, in the overall equity portfolio, move up to quality and focus on those companies that have pricing power and are going to be able to pass on those costs to customers.
When you talk about cost pressures and you talk about a hot cycle over the next 2 years, yes, perhaps shorter than past, but still very hot relative to what we have seen, does that cohere with an inflation break-even rate right now that I'm looking at over the next 2 years of 2.66%, over 5 to 10 years of 2.3%? These are not astronomical figures, albeit some of the highest levels that we've seen in years.
Yeah, absolutely. And I think that's a function of just the complacency and a little bit of the lull that has set in for investors following the last cycle. I think there's some key differences between this cycle and last. I think you're going to see that manifested in the labor markets. We're seeing drastic labor supply shortages. You're going to see that play out in geopolitics, which has certainly diverged since 2008, 2009. And you're seeing the ramifications of some political and trade dynamics in chips and technology. That's causing inflation in certain areas. And so things are different. I think the biggest takeaway, really, why this time is different and why that number might be too low is fiscal, right? And you're going to hear more tonight, as we've talked about potentially more spending. We'll see if there's the math and the support for that in the Congress later on. But nonetheless, we see fiscal leading to higher inflation.
Daniel Skelly, out 2 to 3 years, have you seen use of cash change? Do you see a corporate behavior that actually changed use of cash? I don't see it with Google.
Yeah, that's true. You're seeing more of the buyback trend that had defined the last cycle. Let's see what happens with capital gains and taxes, Tom. You know, what happens with the treatment of dividends? Do dividends become a more attractive source of capital return going forward if they're somewhat more insulated in terms of the capital gains tax issues? So, you know, I tend to agree with you. I think some of these really big companies have tremendous cash hoards, and we're going to hear more from the banks, frankly, later this year. As they continue to see reserve releases and earnings improve, they're going to be buying back more stock. So I think it's a combination of a lot of the things we've been seeing.